Hello viewers, welcome to my channel. I'm Hasham. So I'm doing the problem on current cost accounting CCA method. In the last video I have completed two problems on current cost accounting CCA method of adjusting the financial statements according to price level changes. So the topic going on is accounting for price level changes. It is also known as inflation accounting. So in this method, two methods we have, that is CPP method and CCA method. Almost 25 problems I have done on CPP method, current purchasing power method. And last video I have started the second method, CCA method, current cost accounting method of adjusting the financial statements according to price level changes. So if you have watched the earlier problems, definitely you got some command on this topic of price level changes. If you have not watched the earlier videos, I suggest you to go to the playlist of my channel. Select the subject Advanced Corporate Accounting. In that, select the topic accounting for price level changes. Watch the earlier videos, then you can easily understand this. If you join in the middle, you may not be able to understand. And one more thing, watch the video till the end. Don't skip in between if you want the complete command on this topic. Now I'm going to start the next problem, problem number 3. So before starting the problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So keep the problems ready. Now I'm going to start the third problem. A new equipment was purchased by Sun Limited on 1st January 1997 for rupees 2 lakh. The useful life of the machine was estimated at 10 years. The date of purchase 1st January 1997. The cost of the machine 2 lakh. And the estimated life 10 years. The cost of similar new equipment as on 1st January was 4 lakh. On 31st December 2000 it is available for 5 lakh. The current year is 2000. The 1st January 2000 its value has increased to rupees 4 lakh. Actually we have purchased the machine on 1st January 97 for rupees 2 lakh. Now if we replace by a new machine, the new machine will cost 4 lakh rupees on 1st January 2000. And 31st December 2000, its value further increased to 5 lakh rupees. Sun Limited has decided to prepare an inflation adjusted balance sheet that will form part of its annual report using CCA method, current cost accounting method. The company wants to adjust the financial statements according to price level changes. And the company wants to adopt CCA method, current cost accounting method. This is the first time that Sun Limited will present inflation adjusted financial statements. Required. Calculate the amount of depreciation adjustment, additional depreciation and backlog depreciation for the year 2000. Ultimately, in this problem we have to calculate three things. First one, depreciation adjustment. Secondly, additional depreciation. Thirdly, backlog depreciation. Three things we have to calculate. The information is given in the problem. 2 lakh rupees is the original cost of the asset when it is purchased on 1st January 97, life 10 years, and current year is 2000. 1st January 2000, its value is 4 lakh rupees. 31st December 2000, its value increased to 5 lakh rupees. Now we have to make adjustment, depreciation adjustment. See here. Depreciation is being calculated on average replacement cost because we are given the replacement cost at the beginning of the year and end of the year. 1st January 2000, 4 lakh. 31st December 2000, 5 lakh. When opening and closing are given, so we can calculate the average replacement cost. So current cost value of equipment on 1st January 2000, beginning of the year, is 4 lakh, and current cost value of equipment on 31st December 2000 is 5 lakh. So we can take the average 4 lakh plus 5 lakh divided by 2. Average replacement cost 4 lakh plus 5 lakh divided by 2, 4 lakh 50,000. 4 lakh 50,000 is the average replacement cost during the current year 2000. Now we can calculate depreciation as per CCA and depreciation as per HCA, historical cost accounting. First we calculate what is the depreciation for the current year according to CCA method. So what is the life of the equipment? 10 years. What is the average replacement cost? 4,50,000. So 4,50,000 divided by 10, 45,000 is the depreciation as per CCA. Depreciation as per current cost accounting, 4,50,000 divided by 10, 45,000. And depreciation as per historical cost accounting, HCA, what is the original cost? 2 lakh. So 2 lakh divided by 10, 20,000. So 20,000 is the depreciation as per HCA. So how much is the depreciation adjustment? The current year depreciation adjustment will be depreciation as per CCA minus depreciation as per HCA. 45,000 minus 20,000. 25,000. So depreciation adjustment is equal to 45,000 minus 20,000, 25,000. That's all. First point completed. It is asking you to calculate depreciation adjustment over. Now since current cost value of 5 lakh rupees and we are in the 4th year, see 97 we have purchased. So 31st December 97, 98, 99, current year 2000. That means we are at the end of the 4th year. So at the end of the 4th year, the value of the machine, the current cost of the machine is 5 lakh rupees. Since the current cost value 5 lakh and we are in the 4th year, so depreciation for earlier 3 years will be 5 lakh divided by 10 into 3. The current cost value at the end of the current year is 5 lakh. At the end of 2000 year is 5 lakh. Now if we provide depreciation at this current value for the last 3 years, because 97, 98, 99, 3 years are over. Now we are in the 4th year. So what is the total depreciation of the last 3 years? So 5 lakh divided by 10 into 3. You will get 1,50,000. So 1,50,000 is the total depreciation for 3 years according to current cost. According to current cost. Now however, depreciation in the last 3 years has been provided as per HCA. As per HCA, historical cost accounting, every year depreciation 20,000. 20, 20, 20. 60,000 rupees depreciation we have already provided in the 3 years on HCA method. So 2 lakh divided by 10 into 3. 60,000. So last 3 years according to HCA we have provided 60,000. Whereas according to current cost system, the end of the year, the current cost at the end of the year is 5 lakh. So depreciation for the last 3 years are 1,50,000. So 1,50,000 is the current cost depreciation. Whereas HCA depreciation is 60,000. So how much is the backlog depreciation? Backlog depreciation is 1,50,000 minus 60,000. You will get 90,000. However, depreciation, backlog depreciation is 1,50,000 minus 60,000, 90,000. So 2 answers completed. First, depreciation adjustment 25,000. Secondly, backlog depreciation 90,000. Last one, additional depreciation. How much additional depreciation we have to provide during the current year 2000? Now, CC value of equipment on 31st December 2000 is 5 lakh rupees. The current cost, CC stands for current cost. The current cost value of the equipment on 31st December 2000 is 5 lakh. Now cumulative depreciation up to 31st December 2000 is 5 lakh divided by 10 into 4 years, 2 lakh. 5 lakh divided by 10 into 4 years. Because we are calculating up to 31st December 2000 including current year. So 97, 98, 99, 2000. The 4-year depreciation, cumulative depreciation of 4 years comes to 2 lakh. Now from this, how much total depreciation we have provided, we have adjusted, that we'll find out. So depreciation provided as per HCA up to 1st January 2000, up to the beginning of the year, up to the beginning of the current year is 2000. The last 3 years we have provided depreciation according to HCA, historical cost accounting method. So 20, 20, 20, 60,000 rupees depreciation we have provided in the last 3 years. Apart from that, backlog depreciation. Backlog depreciation up to 1st January 2000, already we have calculated backlog depreciation is 90,000. Backlog depreciation is 90,000. And current year's depreciation as per CCA. As per CCA, current year depreciation, here we have CCA 45,000. Take the total, 60,000 plus 90,000 plus 45,000, you get 1,95,000. So total adjusted value is 1,95,000. Whereas our total depreciation according to this current cost value, cumulative depreciation 2 lakh. So according to cumulative depreciation, the total depreciation for 4 years should be 2 lakh. Whereas we have already provided up to the current year depreciation 1,95,000. So additional depreciation, how much we have to make? So 2 lakh minus 1,95,000, 5,000 rupees additional depreciation we have to provide during the current year 2000. That's it. So this is the complete explanation of problem number 3. Now we'll come to the next problem. Problem number 4. See, it's a bit lengthy problem. See carefully. First attempt itself you may not be able to understand. But if you rewind the video and watch it again twice or thrice, definitely you can get it. Starting 2-3 problems are a little bit lengthy and difficult. After this 4th problem, the remaining problems are easier one. It's not so difficult. Now, X Limited had the following fixed assets on 31st December 1998. So, 3 assets are given: land, building, plant. The cost of the land is 30,000, depreciation dash, net amount 30,000. We already know land is a non-depreciable asset. There will never be depreciation on land. It is indestructible property of the earth. It will not depreciate. Land and building are there, then there is a depreciation. If only building is there, depreciation. But only land, no depreciation at all. So here no depreciation on land. The beginning of the year 30,000, end of the year also 30,000. Whereas building cost was 80,000 and depreciation provided so far on building 24,000. And the written down value of the building is 56,000. And then plant. The total plant value on 31st December 1998 is 2,60,000. Depreciation provided 96,000. And the WDV of the plant is 1,64,000. So remember carefully, understanding the problem is half solved. So try to concentrate on the contents of the problem. So 3 assets are given: land, building, plant. And these assets are given on 31st December 98. No depreciation on plant, same value, beginning of the year, end of the year. Whereas building, there is depreciation, plant, there is depreciation. Plant includes 60,000 installed on 1st January 1998. Wow. Total plant on 31st December 98 is 2,60,000. And it is saying that 60,000 worth of plant, new plant was purchased on 1st January 98, beginning of the current year. That means we'll divide into 2 plants, plant 1, plant 2. Plant 1 was 2 lakh rupees and it is old plant coming from last year. And a new plant is purchased during the current year, that means beginning of the current year on 1st January 98 for 60,000. That's why 2,60,000 is given. So we segregate 2 lakh rupees plant, then 60,000 rupees plant. Then plant includes 60,000 installed on 1st January 98. Depreciation was charged at 5% on building and 10% on plant according to straight line method, fixed installment method. Then replacement cost indices are as follows. Here index numbers are given: asset, land. On the date of acquisition, the index number for land was 100. On 1st January, it is 250. On 31st December, it is 300. These are the index number we have to make use for replacement value. Because we are following current cost accounting, CCA. So we want the current cost. So how to find out the current cost? By using the indices. By using index number, we will find out the current cost value of the asset. Similarly, building. At the time of acquisition, index number 100. On 1st January, 200. And 31st December, 220. Plant. At the time of acquisition, 100. On 1st January, 180. On 31st December, 225. You are required to show how the balance sheet items will get affected by the changes according to CCA method. Balance sheet items means these are the items which will appear in balance sheet. Land, building, plant. These are the items which will be taken in the balance sheet. How these items will get affected by changing with the current cost value, current cost accounting method. If we adopt CCA method, how the value of assets will get changed. That means change in the value of depreciation. So again we have to find out what is the depreciation, depreciation according to CCA method, a backlog depreciation, additional depreciation. That's what we have to find out in this problem. First of all, I am making a table to find out the depreciation as per CCA method, current cost accounting method. See, first asset, first column asset, land, building, plant. I have taken two different plants, one old plant, one new plant. Or we can call it as plant 1, plant 2. Plant 1 was the old plant coming from the last year, 2 lakh. And new plant is purchased during the current year on 1st January 98 for 60,000. That is plant 2. Land. Land value is given in the problem 30,000. The value of land is given in the problem as 30,000. Now we have to find out the replacement cost by using the indices. So after asset, current cost as on 1st January 98, current cost as on 31st December 98. Two columns. The current cost value at the beginning of the year, current cost value at the end of the year. How to find out? By using the indices. See here, land. The actual cost of the land, historical cost of the land is 30,000. Now we multiply with the correction factor. What is the end of the year index number? End of the year index number for land is 300. For land is 300. And at the time of acquisition, its value was 100. So end of the year it is 300. And on 1st January 1998, beginning of the year it is 250. So first we find out the current cost on 1st January. Current cost on 1st January. So 1st January index number 250, at the time of acquisition 100. So 250 by 100. 30,000 into 250 by 100, 75,000. So 75,000 is the current cost value on 1st January 98. 1st January 98, 75. Similarly, I want the current cost value on 31st December 98. So 31st December 98 index number was 300. So 300 by 100. So 30,000 into 300 by 100, how much it will become? 90,000. So 90,000 is the current cost on 31st December 98. So actually historical cost 30,000. We have to convert it into current cost on beginning 1st January and on 31st December. So 1st January 250 by 100. 31st December 300 by 100. We have converted. Now building. Similarly, we have to take the building. Building historical cost is 80,000. 80,000. Now first we want at 1st January. So 80,000 into 1st January index number was 200 and date of acquisition 100. So 200 by 100. 80,000 into 200 by 100, 1,60,000. Take 1,60,000. Similarly, end of the year. The end of the year index number was 220. 220 by 100. 220 by 100 into 80,000, 1,76,000. We got 1,76,000. So we got the current cost value beginning of the year 1,60,000, end of the year 1,76,000. This is for building. Now similarly for plant, we have segregated the plant 2 lakh and 60,000. So first I am taking 2 lakh. 2 lakh. 1st January the index number was 180. So 180 by 100. So plant 2 lakh into 180 by 100, 3,60,000. I have taken 3,60,000. Same 2 lakh into 225. End of the year index number was 225. 225 by 100. You will get 4,50,000. So here you can see 3,60,000, 4,50,000. New plant was purchased on 1st January 1998. So what is the cost? 60,000. Now end of the year. So end of the year, the index number was 225. End of the year. Beginning of the year, index number was 180. So 225 by 180. So here you can see plant value 60,000 into 225 by 180. Because this plant was purchased on 1st January 1998. The index number at the end of the year, index number at the beginning of the year, 75,000. I have taken 70. So we got the current cost value at the beginning of the year, current cost value at the end of the year. Now average. Average means simply you add up the two and add up both the values and divide by 2. 75,000 plus 90,000 divided by 2, 82,500. 1,60,000 plus 176 by 2, 168. 360 plus 450 divided by 2, 4,05,000. 60 plus 75 divided by 2, 67. Yeah, average. Average cost. Now we can easily find out the depreciation as per CCA. First of all, no depreciation on land. So put a dash. No depreciation on land. Now, on this building we have to provide depreciation. What is the rate of depreciation? 5% given. On building 5%. So what is the average value current cost? 1,68,000. So 1,68,000 into 5%, 8,400. 4,05,000 into 10% on plant. On plant, the depreciation rate is 10%. So 10% of 4,05,000, 40,500. 10% of 67,500, 6,750. So we got depreciation as per CCA. Now depreciation as per HCA, historical cost. Historical cost means it is given in the problem, building 80,000. 5% of 80,000, 4,000. 10% of 2 lakh, 20,000. 10% of 60,000, 6,000. This 10% of 2 lakh, 20,000, 10% of 60,000, 6,000. And 10% of 40,000, 4 lakh. 10% of 80,000, 5%, sorry. 5% of 80,000 is 4,000. So we got the HCA. Now depreciation adjustment. Depreciation adjustment means depreciation as per CCA minus depreciation as per HCA. So how much? 8,400 minus 4,000, 4,400. 40,500 minus 20,000, 20,500. 6,750 minus 6,750. So adjust it. Depreciation adjustment over. Now cumulative depreciation up to 31st December 98. Cumulative depreciation. So there is no depreciation on land, put a dash. For building. Building 52,500 is the cumulative depreciation. How we got 52,500? Here in working notes I have shown. Percentage of depreciation provided on building. In the problem, 24,000 rupees is the depreciation on building. What is the cost here? 80,000. On 80,000, 24,000 depreciation. So what is the percentage? 24,000 by 80,000 into 100, 30%. That means on building, so far we have calculated 30%. We have charged 30% depreciation. Now cumulative depreciation up to 31st December is 30% of 1,76,000. What is the current cost value on 31st December? You can see here. For building, the current cost is 1,76,000. So we calculate 30% of 1,76,000. 30% of 1,76,000, 52,800. So 52,800 is the cumulative depreciation on building. Right? Now we have to calculate current cost WDV as on 31st December. Very simple. Take the current cost at the end of the year minus cumulative depreciation. What is the current cost at the end of the year building? 1,76,000. This is the current cost, 1,76,000. 1,76,000 minus 52,800. Here I have shown. The current cost WDV as on 31st December, 1,76,000 minus 52,800, 1,23,200. So from 1,76,000. 1,76,000 minus 52,800, you will get 1,23,200. Same procedure for plant. We will calculate for plant. So building. Plant at the beginning of the year 2 lakh. Plant purchased during the year 60,000. Total 2,60,000. So depreciation on 2 lakh rupees is 90,000 and depreciation on 60,000 is 6,000. Here in the problem it is given 2,60,000 plant and 96,000 depreciation. So we have segregated 2 lakh rupees plant and 60,000. 60,000 के ऊपर 6,000 depreciation. 2 lakh rupees के ऊपर 90,000 depreciation. On 2 lakh worth of plant 90,000, on 60,000 6,000. The percentage of depreciation 90,000 divided by 2 lakh into 100. 45%. The old plant 2 lakh. On old plant 90,000 depreciation provided. So 90,000 by 2 lakh into 45%. Now we have to charge 45% depreciation on old plant. What is the closing value of old plant? 4,50,000. Closing value, current cost on 31st December 98 is 4,50,000. Now 45% of 4,50,000. Here, cumulative depreciation. 45% of 4,50,000, it comes to 2,02,500. So 2,02,500 is the cumulative depreciation on old plant. Right? Now WDV. So deduct it. 4,50,000 minus 2,02,500, 2,47,500. Here I have shown current cost WDV at the end of the year. 4,50,000 minus 2,02,500, 2,47,500. That's all. Now last plant. The last plant at the end of the year, what is the value of the plant? 75,000. The current cost value at the end of the year, 75,000. How much is the cumulative depreciation? 7,500. 7,500, 10%. 10% of 75,000, 7,500. Subtract 75,000 minus 7,500, you will get 67,500. That's it. So these are the calculations regarding depreciation according to CCA. Now, backlog and additional depreciation. Backlog and additional depreciation asset, building, plant 1, plant 2. I am not taking land because there is no depreciation on land. Building. Current cost value on 31st December 98, here we have already calculated. At the end of the year, 1,76,000, 4,50,000, 75,000. Now, cumulative depreciation, already we have calculated. 50 to 800, 2,02,500, 7,500. From here, I have taken here. Now, cumulative depreciation at current cost accounting on 1st January 98. This we have to calculate. That means cumulative depreciation as per CCA on 1st January 98. How we got 40,000 and 1,26,000? Here I have shown. Now see here. Cumulative depreciation up to 1st January 98. Building 1,60,000. 1,60,000 is the opening value of building. See here. Current cost value on 1,198. 1,60,000 is the current cost value into 5%. Building per depreciation 5% into 5 years. How we got 5 years? Here I have shown. Number of years. Building rate of depreciation 5%. Depreciation per annum is 5% of 80,000, 4,000. So every year 4,000 rupees depreciation on building. So total depreciation provided 24,000. It is given in the problem. Total depreciation on building 24,000. The number of years is equal to 24,000 by 4,000, 6 years. So at the end of the year, 31st December 98, up to 31st December 98, it is 6 years. 24,000 by 4,000 is 6 years. But we want up to 1st January 98, beginning of the year. So it will become to 5 years. That means building. The building has been purchased 5 years back, up to 1st January 98. So here, building 1,60,000 into 5% into 5 years, 40,000, this 40,000. Similarly, plant 3,60,000. 3,60,000 is the opening value of plant. Opening value of plant 3,60,000 into 10% into 3.5 years. How 3.5 years? Here. The rate of depreciation 10%. Depreciation per annum 10% of 2 lakh is 20,000. And total depreciation provided 90,000. The number of years 90,000 by 20,000, 4.5. 4.5 years. So up to 31st December 98, 4.5 years. Up to 1st January 98, 3.5 years. The beginning of the year 3.5 years. So we multiply 3,60,000 into 10% into 3.5 years, 1,26,000. So 1,26,000. This is the cumulative depreciation on 1st January 98. So the second plant was not purchased, it was purchased on 1st January only. So there is no cumulative depreciation for second plant. Now current year depreciation as per CCA. Already you have calculated current year depreciation as per CCA. 8,400, 40,500, 6,750. Now depreciation. Backlog depreciation. So how to calculate backlog depreciation? Here I have calculated. Backlog depreciation on building 1,76,000. This is the closing value of building. Current cost as on 31st December. So backlog depreciation. The backlog depreciation 4,000 and 31,500. How we got this? Here I have shown the calculations here. Backlog depreciation on building 1,76,000 into 5% into 5 years. The total number of years already we have calculated here, 5 years. So 5%, 1,76,000 is the closing value of building. So it comes to 44,000 minus beginning of the year. The value at the beginning of the year is 1,60,000. Building value beginning of the year 1,60,000. So 1,60,000 into 5% into 5 years, 40,000. So backlog depreciation 4,000 rupees for building. So building 4,000. Similarly, plant 1. Plant 1 closing value is 4,50,000. So 4,50,000 into 10% into 3.5 years. It comes to 157,500. Similarly, beginning of the year 3,60,000. So 3,60,000 into 10% into 3. So the backlog depreciation 4,000 and 31,500. How we got it here I have explained you. Backlog depreciation on building 1,76,000 is the closing current cost. 1,76,000 into 5% rate of depreciation into 5 years. Already we have calculated years, 5 years. Then 1,60,000 is the opening, beginning of the year current cost. So 1,60,000, 5% 5 years, 4,000. Similarly is the case for plant. 4,50,000 into 10% into 3.5 years. Similarly 3,60,000 opening plant value into 10% 3.5 years, 31,500. So total backlog depreciation 35,500. Now additional depreciation. Additional depreciation here I have calculated. Depreciation as per CCA minus depreciation as per CCA on 1st January 98. Depreciation as per CCA already we have calculated 8,400, 40,500, 6,750 minus depreciation as per CCA at the beginning. Beginning of the year, what is the CCA here? 1,60,000, 3,60,000, 60,000. So 1,60,000, 3,60,000 and 60,000. 5% for building, 10% for plant, 10% for plant. So 400, 4,500 and 7,750. 4,500 and 750. These are the additional depreciation. That's all. So this is the end of problem number 4. Totally 4 problems we have completed on current cost accounting, CCA method.